So the ability to loan to technology-based type companies on operating capital, working capital, those types of things. Is that fair? Okay. Who wants to?
You pose a really good question because banks, especially in southeastern North Carolina, have been commercial real estate by and large. And although we certainly have procedures and policies in place to lend to other types of industries, of course, it can be difficult. The infrastructure, yes, is there. Infrastructure, I mean, again, the policies, we are looking for. Believe you me, in this period, we are not as interested in lending money. We have to divest ourselves from the commercial real estate buckets, and I say that generally. But, you know, with technology companies, some service companies, what we typically get into is a kind of a collateral cash flow balance where it's difficult to lend on accounts receivables and inventory in some respects because they can be somewhat unsecured. If we had to collect on an accounts receivable, for example, and I've gone through this, the small business knows well ahead of the bank that things aren't going well. By the time we get to it, those receivables are essentially gone, as is inventory and such. So we do lend on it. The loan to values are much less, probably 50 to 70%, depending on the type of business. But in a case with a technology company, we have to look at the cash flows that are being generated from either a supporting business or your existing one. And a lot of times, the reality is we have to just be honest and say this is not a traditional bank type of loan. This is really equity. Some of the folks at the table here is a great resource for that, and it's difficult. I do think from a trend perspective, you are going to see banks finding a way to become much more flexible in that area of lending because, as I said, we have to divest ourselves. So,
maybe one other point to consider when you're looking at those type opportunities. If businesses are moving into the area to kind of act as subs for larger GE, bigger corporations, a contract, a lot of times that helps banks get comfortable with there is truly a commitment from the person that's going to be supplying you the potential sales. That's an important piece in that underwriting. And a lot of times these businesses they'll travel from another state. I mean, they follow these big companies around, so they have a track record. They usually have good operating numbers. They usually come in with cash, and so those opportunities will be around. And that's the kind of thing that the banks need to look at so that we can diversify our portfolios so that we're not just driven by real estate. There are a lot of other opportunities that you get from the small operating companies. You've got cash management services, different deposit products, a lot better deposit products, insurance, a lot of other things that give us an opportunity to sell. So we'd very much look at those.
Thanks, Dallas. I had a real quick question, and this is mainly to Mark and to Brad. Listening to Capstone's circumstances, he's got a guy that's 75% pre-sold project. You must be looking at some key indicators, whether they're market, is it absorption, is it job growth? I mean, what are the indicators you're looking at before you start seeing A&D and even projects which, on their own merit should stand and would easily have stood 5-7 years ago and don't stand now?
Brad, I'll let you go first.
You don't want to go second.
I think that in a case, in that particular case, I do not know the details, but there are a lot of instances where the pre-sales, people have an interest. They may not have a whole lot of money down. Their intention is to buy that potential property and either rent it or live in it or whatever the case may be. I think that banks have been very gun shy because we've experienced a lot of fallout in those particular type instances. Back when the market was running strong and on fire, that all it would take is, I have these 4 pre-sales. I need to build 6 units. Let's roll with it. It's not to say that banks would not entertain that type of product, but it's usually the bank that has that project at that point in time. Going out and taking it from another bank and moving it along, that's just, I think most all banks have that same type product in their portfolio, and we're trying to help the clients that we have get through those situations. We're relying more on permanent takeouts. Let's take it another step, not just show me the contract instead of a $500 deposit. Show me some real money, and then show me where you're going to get your financing. And with those variables, and we may throw a few other things out, we may even have to underwrite those people ourselves. We'll do everything we can to try to make that happen.
Yeah, David, it's a great question. It's frustrating, I know, especially in the development community, but gun shy is probably a great word. And until some of the inventory gets absorbed, until there's still a lot of concern out there. The residential side of the world has now bleeding into the commercial real estate. Some of those problems. Until there are real active signs of development and not development from a construction standpoint, from development in our markets, and that things are, it's going to be difficult. Brad hit on the key thing is that if the current bank where you have your loan is most likely going to be your best bet to go back and in their interest to see that thing through. Ultimately, and it's a discussion for another date, it really comes down to some discussions around capital and where we are, from a portfolio and risk management, where we're allocating our capital at the moment. And it's very expensive, when we book a loan. That's something offline, David, we'll be more than happy to discuss. So.
I have a question that's not for the banks. Cheryl, this question is directed toward you, just for the business owners in the room. If you typically have an investment in an IRA or 401k and you pull funds out, it's typically a taxable event. So the type of funding you're looking at using the 401k to fund a business, is that going to be taxable to the investor or the owner?
Thank you, Marcus. That's a great question. No, it is not a taxable event. Due to the structure, it is an IRS-approved product, and part of the process is an IRS approval letter is obtained on your behalf, and then they're, again, going back to structure, they do want to set that up as a C Corp for your new 401k to meet those guidelines, and at that point, once all the criteria has been satisfied, then it does transfer with no tax implications.